Good afternoon, everyone, and welcome. This is a market update for the month of August, and today is September 6th. For the last 6-8 months or so, I've been saying one of two things, possibly three things will happen. The data will continue to weaken until we start to see a drop, and that drop and that recession may come as a bit of a surprise, as the market is not fully reflecting that. And the data that we see today continues to show some weakness. We may see a soft landing, which is certainly what the market intends we'll see, in which case, at some point, data should start to show improvement, and that improvement should be a bit more consistent. In either case, the problem that we've had the last 18 months is this market has been extremely narrow. It's been mostly large mega cap tech stocks that have dragged the market much higher, with most of the other areas of the market lagging severely behind. So the thought is, if there is to be any improvement in the market, it would have to come as a broadening out. So let's just spend a few minutes looking at some of the data. Some of this may be very familiar because it looks a lot like the stuff from last month. This is the LEI through July. We won't have the August numbers for another week or so, but the July numbers did see a sharp drop in the leading economic index, dropped 0.6%. We see a huge drop over the last 2 years. Second largest drop recorded, certainly the second largest drop in the last 65 years. And anytime we've seen a drop like this, it winds up being a recession, no exception. If this were a soft landing, we would see the internal box looking a bit more like a Nike swoosh as opposed to it continuing to drop. The yield curve, which has remained inverted, continues to through September, at least to date, is beginning to flatten out a bit. So what we're looking at are three curves. The top one was from a year ago, September. The blue one, or the one in the middle, is current. And the one at the bottom, which is healthy, higher yields further out, shorter yields up front, are from 2 years ago. This yield curve is starting to flatten. And that's an important point, because historically, whenever we've had an inverted yield curve, by the way, this is now the longest inversion ever recorded, the longer the inversion, the longer the recession, the deeper the recession typically is, although there's not a lot of data on that. But the more important point is that the yield curve starts to flatten and then revert as opposed to inverse. That's when the recession comes. And we'll see the blue line here, especially the blue line below the red horizon, which would be a negative yield spread, which would be all those periods in history where the yield curve was inverted. And you'll see a drop below the red line and then start to move up to the red line or above the red line just before each recession. And we're now getting to that point as the yield curve is now flattening out. For many, I've expressed this data. For some of you, it's new, and that is the Assam Rule was just recently violated. It takes into consideration unemployment, the rate of change on unemployment as it relates to economic slowdown. Whenever that rate of change, the difference in the average of the last 3 unemployment rates compared to the lowest unemployment rate in the last 12 months, whenever we see a spread of 0.5% or more, we're typically right on the cusp of a recession without fail, and we're there now. So again, doesn't mean that we're going to see a recession today or tomorrow, but the data is certainly beginning to weaken. All of this data is like big, huge icebergs floating amongst the ocean. It's important to look at direction. In between this, we have more high frequency data. And the high frequency data comes out monthly, sometimes weekly, but a lot more often. And we're beginning to see data continue to erode, not significantly, but certainly measurably each and every reporting period. Manufacturing ISM numbers continue to weaken. They're a bit lower this month than last month. The JOLTS job opening report, that was a federal report, showed this month, or the most recent month reported, which was July, that number came in lighter than June and quite a bit lighter than expected. So there's less new jobs being opened. In terms of jobs being created, that number is quite a bit weaker than expected. That came out today. And all the while this is happening, this market that has been very, very narrow, which is beginning to broaden out a bit, has also peaked, meaning the most recent highs were put in actually quite some time ago. Here we are, September 6th. The S&P peaked July 16th. The NASDAQ peaked July 10th. This is generally how these things go. And there's also a household survey that was just released as well. It's an unemployment or employment survey where they're actually polling individual households. And it showed, in terms of jobs created, jobs growth, 168,000. That's combined part-time as well as full-time. But the trend has been vastly more part-time jobs than full-time, which means that the unemployment rate, which is now 4.2, it was 4.3 just 2 or 3 weeks ago, gets bounced around a bit depending on the contraction or expansion of number of people seeking jobs, and those that can't get full-time but are plugging the hole with a part-time job, they're considered still employed, but obviously compromised. The important thing is, year to date, the number of part-time jobs created in this country, 527,000, all registered as new jobs created. At the same time, there were 438,000 full-time jobs being eliminated. So you'll see this contraction, full-time to part-time to no time. We talked about the concentration of the market. That's beginning to change. Through the first half of the year, it was all big tech, with the S&P up 15, the NASDAQ up 19, and the Dow, the Russell, even bonds were flat or negative. And that was true through the second quarter and the first half of the year. And the reason was big tech. The reason was the Magnificent Seven, which contributed significantly, greatly, contributed more to the S&P than the other 493 stocks amongst the S&P. Then we saw something change. In July, we started to see a bit of a broadening out. The S&P was up, the NASDAQ was down. The Dow, the Russell, even bonds were outperforming the S&P. First time in a very long time. And here we are now, just completed August. We're seeing a bit more of that as well. We're seeing returns off of the Dow or off of international, or even bonds that are up. It's not all concentrated in big tech. And that's important, because this broadening out means one of two things. Either the market is anticipating better times ahead, or it's the last gasp of people who felt denied, people who felt they missed the boat, those who want greater market exposure, but don't necessarily want to purchase large tech, Magnificent Seven, are moving into some of these areas that have lagged a bit behind. Value outperformed the S&P. So as I've said now for quite a while and continue to say it, we're data dependent. We'll adjust the portfolio accordingly. The portfolio is still really quite conservative. That is, the large IRAs are dynamic growth portfolio. Recession is still somewhat our base case. We believe that to be the case, as this data is certainly degrading and not improving, and the markets are now reacting to that. Soft landing is what the markets still believe. They think cutting rates will effectively juice the market. It could in the very short term, but it's probably more indicative of a lot more weakness that the Fed sees that they're not telegraphing. But if it were a soft landing, we would see somewhat of a Nike swoosh, the data continue to improve. And that's it. That's kind of where things are for the month of August. We'll do this again in September, but we'll probably talk about that as it relates to the full quarter. Doing this just so you got a better sense for what's happening in the portfolio, why we're doing what we're doing. We moved a lot of money out of money market into bonds, because bonds are starting to outperform here a bit. And we think we'll get a better return on bonds than we will money markets. As interest rates fall, money market yields also fall. So again, thanks so much. See you soon. Take care.